XRP, the case for the most deeply entrenched payment network in crypto. Hey everyone, welcome back to XRP Future Finance. I want to start with a question. What if the lawsuit everyone thought was going to bury Ripple actually ended up being the best thing that ever happened to it? 5 years of SEC enforcement, billions in legal exposure, constant uncertainty hanging over the asset, and yet Ripple walked out the other side with more banking relationships, more regulatory clarity, and more institutional infrastructure than it had before the case even started. That's not a coincidence, and it's not luck either. While the headlines focused on courtroom dates and legal filings, Ripple was quietly stacking up partnerships, building out a stablecoin, and laying the groundwork for a banking charter most fintech companies could only dream about. So today we're going to walk through exactly how XRP got here, and why this entrenched position in global payments deserves a much closer look than most people are giving it. Let's go back to the beginning because XRP's history is longer than a lot of people realize. The asset has been around since 2012, which means it actually predates Ethereum by 3 years and sits right alongside Bitcoin and Litecoin as one of the earliest cryptocurrencies ever created. But here's what separates XRP from those other two assets. It's the only one of the original group that spent half a decade under direct SEC enforcement while simultaneously building the largest institutional banking network in digital assets. The lawsuit is settled now. Ripple has more than 300 banking partners spread across 45 countries, a conditionally approved national trust bank charter, a stablecoin in RLUSD that's custodied by Bank of New York Mellon, and a $1.25 billion prime brokerage acquisition that closed just months after the case wrapped. Most companies facing that kind of legal pressure spend their resources defending themselves. Ripple spent its building. Rewind to late 2019, right before the lawsuit hit, and you'll see Ripple wasn't some early-stage project anymore. It had a real, live institutional client base processing actual commercial volume across multiple regions. Back in June of that year, Ripple put $50 million into MoneyGram as part of a deal to expand on-demand liquidity into international payment corridors. By the end of 2019, MoneyGram was routing close to 10% of its Mexican peso foreign exchange volume through that system, and had expanded coverage into Europe, Australia, and the Philippines. That made MoneyGram the first money transfer company anywhere to deploy blockchain-based liquidity at real scale. This wasn't a pilot program buried in a press release. It was live money moving through real corridors. The banking signups during this period weren't slowing down either. Axis Bank in India went live on RippleNet back in November 2017, processing cross-border payments alongside Standard Chartered Singapore and RAK Bank in the UAE across the Singapore-India trade lanes. Santander launched its OnePay FX app on RippleNet around the same time, and that product eventually expanded into 19 countries, handling something close to half of the bank's total annual international transfers. American Express plugged RippleNet's messaging infrastructure into its B2B cross-border payments between the US and the UK in 2017, although that particular deployment ran on Ripple's Xcurrent messaging layer rather than XRP directly. On top of that, Bank of America joined RippleNet and has confirmed piloting Ripple's payment rails, and PNC joined the network around the same window and has stayed connected ever since. The international footprint kept growing from there. Faisal Bank in Pakistan went live on RippleNet in 2019. At the same time, Tranglo in Malaysia and SBI Remit in Japan were quietly building out corridors across Southeast Asia and Japan that would later become some of the most important pieces of the entire ODL network. Ripple wasn't just chasing commercial banks either. As early as 2021, the company partnered with the Royal Monetary Authority of Bhutan to explore central bank digital currency infrastructure, and that was followed shortly after by a similar collaboration with the Republic of Palau. Ripple's CBDC platform was built specifically so central banks could mint, manage, and redeem their own sovereign digital currencies using Ripple's infrastructure. Montenegro and Colombia joined that list by 2023, and Ripple's CEO eventually confirmed the company had worked with 10 different governments on CBDC projects, with most of those relationships staying confidential by design. Then the SEC filed its lawsuit against Ripple Labs on December 22, 2020, and the momentum that had been building for years took a direct hit. MoneyGram terminated its partnership with Ripple just a few months later, in March 2021. Bank partners who had been in active talks went quiet almost overnight. Compliance departments across the industry put XRP-related projects on indefinite hold, just to stay safe. If you look at how XRP traded between 2021 and 2024, you're really just watching the chart reflect years of legal uncertainty that cut Ripple's flagship product off from US institutional adoption. It's worth sitting with that for a second because a huge amount of infrastructure had already been built, and a single lawsuit put much of it on ice for years. But here's where it gets interesting. Because while the public conversation stayed fixated on the courtroom, Ripple was becoming something close to the default partner for governments exploring digital currency. Between 2021 and 2024, the company ran CBDC pilot programs with Bhutan, Palau, Montenegro, Colombia, the Hong Kong Monetary Authority, the National Bank of Georgia, and at least 4 other sovereign institutions that have never been named publicly. That platform was built specifically to let central banks issue and redeem digital currencies on infrastructure tied to the XRP ledger. Years of working directly with these institutions gave Ripple something that's genuinely hard to replicate, a real understanding of how central banks think about digital settlement, where the friction points sit between government issuance and commercial bank distribution, and what compliance teams at monetary authorities actually need from a technology partner, rather than what looks good in a pitch deck. That experience didn't just sit on a shelf once Ripple moved on to other things. It fed directly into how RLUSD was designed, since the stablecoin essentially fills the same settlement role a CBDC would, just with Ripple as the issuer instead of a national treasury. Ripple's CEO has talked about this connection directly, describing CBDCs and stablecoins as basically the same financial tool, just issued by different types of institutions. In a sense, all those years of sovereign partnerships worked like a long-running product research project, and RLUSD is what came out of it. Now backed by BNY Mellon as custodian, regulatory approval from the DFSA in Dubai, and integration into Visa-linked pilots alongside Ripple's own prime brokerage arm. In February 2025, Ripple redesigned its website and pulled back on CBDC messaging, which got some people speculating the company was stepping away from government partnerships entirely. That's not really what happened. The infrastructure work is done, the relationships are still active, and the commercial product now is a regulated stablecoin that any bank can integrate through Ripple payments instead of a custom platform built for one government. Now let's talk about supply, because this part of the story doesn't get nearly enough attention. All 100 billion XRP tokens were created at the genesis of the XRP ledger back in 2012. There's no mining, no ongoing issuance, and no inflationary schedule built into the system. The founders kept 20 billion XRP, and the rest went to Ripple Labs. In 2017, Ripple locked 55 billion XRP into escrow, releasing it on a fixed schedule of 1 billion tokens per month, with anything unused rolling back into escrow at the end of each cycle. That system has been running for years now, and can be checked on-chain by anyone who wants to verify it themselves. Beyond the escrow, every transaction on the XRP ledger burns a tiny amount of XRP as a fee, permanently removing it from circulation rather than handing it to validators or locking it into staking rewards. That burn has been running quietly since 2012, and on a network that recently peaked at over 2 million transactions a day, the cumulative effect has been a circulating supply that's been slowly shrinking for years. That makes XRP deflationary by design, not by marketing. Right now, the burn rate is still small relative to total supply, but ODL volume keeps climbing as RLUSD transactions increase and the ledger processes more real commercial activity. As that volume grows, the burn rate grows with it, and so does demand for the asset itself. For context, Swift estimates global cross-border payment volume at roughly $5 trillion a day. Ripple doesn't need anywhere close to a majority of that for these supply mechanics to start mattering, especially next to a currency like the US dollar that keeps expanding its own supply year after year. Then, in November 2025, Spot XRP ETFs launched in the US, with Bitwise's fund trading on the NYSE under the ticker XRP and Coinbase custody handling the assets. Spot ETFs require the custodian to hold real XRP against every share outstanding, so every dollar of net inflow pulls actual XRP out of the open market and locks it into institutional custody instead of just tracking the price on paper. By early 2026, Spot XRP ETFs had pulled in more than $1.3 billion in net inflows, adding real supply tightening on top of the ledger's burn rate and the growing demand from ODL corridors. Among the products trading right now, the Bitwise XRP ETF is the most liquid, with a 0.34% expense ratio and Coinbase Prime handling cold storage. As of June 10, 2026, that fund's NAV sat at $12.76 against a 52-week high of $26.88, putting it roughly 52% off its peak. The Canary XRP ETF leads in total assets with $290 million. The 21 shares XRP ETF holds close to $143 million, and the Franklin XRP ETF has $273 million at just a 0.19% expense ratio, the cheapest in the category. All four hold actual XRP in custody. Since these funds launched right around XRP's all-time high, they've pulled back along with the underlying asset, which means the current pricing reflects the same setup you'd see on the XRP-USD chart, sitting well below the highs while the underlying business at Ripple keeps moving forward. Let's shift to the charts now because the technical setup here is genuinely worth paying attention to. XRP dominance and the XRP to Bitcoin ratio have both traded inside the same broad range going back to 2014. Since 2019 specifically, that range has compressed into a tighter band sitting near the lower end, and the average true range has been declining since 2018 without a real reversal. Between 2015 and late 2017, XRP sat at these same suppressed levels for more than 2 years straight. Then in December 2017, right as Bitcoin was rolling over from its peak and the broader market was heading into a year-long bear market, XRP moved in the opposite direction entirely. Over about 2 months, it climbed to a total crypto dominance of 31.32%, passing Ethereum to become the largest altcoin by market cap, and then briefly passed Bitcoin itself, holding the #1 spot for a few hours while the rest of the market was falling apart. The broader trend eventually pulled XRP back down, and Bitcoin reclaimed its position, but the move itself still happened. No other altcoin in crypto's history has done what XRP did that month. It sat comfortably in the top 5 since then, and climbed as high as the top 2 during the most recent bull cycle's peak. What's worth remembering is that this all happened before any of today's infrastructure existed. No banking partnerships, no stablecoin, no ETF access, no regulatory clarity, none of it. Now that those pieces are actually in place, a similar setup playing out again could look very different in terms of scale. There's another pattern worth noting in these charts too. XRP has often tracked Bitcoin's price movements, but usually with a multi-year delay behind it. That started changing at the end of 2024, when XRP finally broke above its previous all-time high and is now trading near that breakout level, potentially in the early stages of confirming a real move. Applying standard Fibonacci extension levels to this setup puts price targets at $27.16, $71.41, and $800 and 16.36 per coin. The middle of that range lines up fairly closely with the Bitcoin fractal XRP has been following, which points towards something near $120, while the upper end would put XRP in territory most people aren't prepared to think seriously about. Given how wide that range is, and how dependent the higher targets are on broader monetary expansion, the more grounded number to watch right now is that 27.16 level, with room to adjust upward if conditions shift. Zooming out further, XRP dominance and the XRP to Bitcoin ratio have both moved within a much larger historical range. Back in December 2017, the total crypto market cap peaked around $830 billion before falling into a year-long bear market. Today's total market is several multiples larger than that, and Bitcoin's price sits an entire order of magnitude higher. That 31.32% dominance level XRP hit in 2017 translated to a price in the low single digits, against a market that was a fraction of its current size. Apply that same dominance percentage to today's much larger total market, and the resulting number sounds almost absurd on paper. But the pattern is real. The legal overhang that held the asset back for years is gone, and the institutional infrastructure behind XRP today is nothing like what existed the last time this kind of move happened. Looking specifically at the XRP to Bitcoin chart, you can see XRP has held a tight support zone, roughly 0.000006 to 0.00002 BTC, across multiple retests in 2017, 2020, 2021, 2024, and 2025. Every single time that ratio has touched this floor, it has held and reversed. Right now, the ratio is sitting right in that same historic zone following the pullback from the 2025 high, and the average true range has compressed tightly across the chart. The last time compression looked like this was right before the 2017 to 2018 run, when XRP rallied more than 4,000% against Bitcoin and over 60,000% against the dollar, moving from $0.0053 to a cycle high of $3.31 in roughly 10 months. That history matters because when this ratio breaks upward from this exact level, the USD chart tends to see its biggest moves, since XRP is outperforming Bitcoin while Bitcoin itself is also climbing, and those two effects compound on top of each other. There's a broader liquidity story worth mentioning too. The spread between M1 and M2 money supply growth and nominal GDP has been flat or declining since 2021, but at the start of 2026, the M1 spread started turning positive against GDP, with M2 likely to follow a similar path. Historically, this kind of shift tends to fuel bigger moves in Bitcoin, and if that happens again, XRP is positioned to be one of the biggest beneficiaries, simply because it's the only asset that's ever actually overtaken Bitcoin's market cap, even briefly. Put together, XRP to USD, the XRP to BTC ratio, XRP's market cap dominance, and the Bitwise ETF are all sitting in the lower end of their respective ranges at the same time, and each one is pointing toward the same potential setup. Now, as extreme as some of these price targets might sound on their own, there's a fundamental case behind a lot of this too, built around how the network actually gets used. Global clearing systems process more than $3 quadrillion annually across tens of billions of transactions. The Federal Reserve's Funds Service alone settled $1.14 quadrillion across 217.2 million wire transfers in 2025. SWIFT routes roughly 1.825 quadrillion per year through its messaging network. The Nacha ACH network processed 35.2 billion transactions worth $93 trillion in 2025. Moving institutional money across borders requires deep liquidity sitting in order books just to prevent large transfers from moving the market against themselves. So something like a $500 million transfer needs real standing inventory to absorb it cleanly. This is where the XRP ledger's speed becomes genuinely useful, since it settles transactions in 3 to 6 seconds, which allows capital to recycle quickly instead of sitting idle. Market makers typically hold a reserve roughly equal to 1 day's average settlement volume in order to keep spreads tight, which sets a rough baseline for how much network capitalization is actually needed to support that throughput. XRP's fixed supply plays into this too, since every transaction burns a tiny base fee of 0.00001 XRP just to keep the network secure from spam. If the ledger ever processed all 49.4 billion of the world's annual transactions, that alone would burn around 494,000 XRP a year. At the end of the day, the value of a payment network like this comes down to how much capital it actually needs to move money efficiently. And that's the part of XRP's story that doesn't always make the headlines, but might end up mattering the most.